Good afternoon, everybody. Welcome to the weekly economic update for Monday, October 17th, 2022. Hope everybody had a good weekend out there. Much better day in the markets compared to, I guess it was Friday where things or Thursday, I don't know. Had a bunch of back and forth days, but looks like across the globe, things look pretty good. So can't complain too much there. If it's your first time watching, please give me a big old thumbs up and hit that subscribe button so you stay in tune with what's going on and with my daily broadcasts. And let's go ahead and jump in and see how things are going. The Dow Jones finished the day up 1.86% at 3185. The S&P 500 was up 2.65%, closed at 3677. NASDAQ was also up quite a bit at 3.43%, closed at 10675. Small caps are up more than 3%. The VIX fell 2.03% today. It's currently at 3137. Although that number is still quite elevated and still makes me a little nervous. Let's see, here in Canada, or up in Canada, they were up 1.61. Brazil up 1.38. Mexico was up 1.71. Headed over to Europe, Germany was up 1.7. UK up 0.9. France up 1.83. Eurostox up 1.77. Netherlands up 1.64. Spain up 2.37. Italy up 1.86. Switzerland up 1.64. And Portugal up 1.61. So you're kind of noticing a trend there. Lots of ones and twos, which is good. Headed over to the Asian markets. They were a little more mixed overnight. Japan was down 1.16%. Australia down 1.4%. New Zealand down 0.65%. In the Chinese markets, they were a little bit better. The Shanghai was up 0.42%. The SESE component up 0.36%. China A50 down 0.45%. The DJ Shanghai down 0.42%. Hang Seng up 0.15%, and the Taiwan weighted down 1.23%. So, but like I said, most of the day was really solid. Lots of 1s, 2s, and 3% increases over the day. So, not too shabby. All right, well, let's go ahead and read through today's weekly update. The week on Wall Street, stocks were mixed last week amid a wide intra and inter-day price swings as technology shares bore the brunt of the downdraft. The Dow Jones Industrial Average gained 1.15. Meanwhile, the S&P 500 slipped 1.55. NASDAQ dropped 3.11. And internationals lost 2.48 for the week. Breathtaking volatility. An above consensus consumer inflation number sent stocks tumbling in early Thursday trading before inexplicably surging higher in a stunning reversal that saw the Dow Jones Industrial Average rally 1,500 points from its intraday low before reversing. Stocks touched levels that it had last seen in 2020. Friday surrendered much of the previous day's gains, sending stocks mostly lower for the week. The stock market began the week on a volatile note with NASDAQ hitting a 2-year low. Recession fears and new export control limit U.S. companies from selling advanced semiconductor chips and related manufacturing equipment to China. So that's why the tech industry took it so bad last week. Sticky inflation. September's inflation report provided little evidence that inflation was moderating meaningfully. The producer price index on inflation showed a 0.4% increase in supplier prices over August and an 8.5% increase over 12 months. While down from August's 8.7% rise, it was higher than the market expectations. The subsequent release of the consumer price index showed consumer prices rising 0.4% in September at 8.2% year over year. More troubling was core inflation, excluding energy and food prices, which gained 0.6% in September and registered an increase of 6.6% from a year ago, the biggest 12-month increase since August of '82. So those numbers are still hot and are making everything more expensive right now. So just have to deal with it for the time being. Economic data coming out this week. Tuesday, we have industrial production. Wednesday is housing starts. And Thursday is existing home sales, jobless claims, and the index of leading economic indicators. Got a bunch of companies reporting earnings this week. Today, we had Bank of America and Charles Schwab. Tuesday is Netflix, J&J, and Goldman Sachs. Wednesday is Tesla, United Airlines, IBM, Procter & Gamble, Lam Research Corporation, and Abbott Labs. Thursday, we have AT&T, CSX, Union Pacific, Freeport-McMoRan. And Friday, we have Verizon, HCA Healthcare, and American Express. So a pretty busy week on the earnings front. So we'll see if that helps or hurts the market. So, all right. Let's read through today's market recap real quick. S&P 500 jumps as positive earnings wave boosts sentiment. The S&P 500 rallied Monday as a wave of mostly better than expected quarterly results from major Wall Street banks lifted sentiment on stocks. Bank of America continued the trend of upbeat quarterly results from Wall Street banks after reporting better than expected third quarter results driven by a strong performance in its fixed income business and higher rates that boosted net interest income. Bank of New York Mellon rallied 5% after its third quarter results also beat on both the top and bottom lines. In other banking related news, Goldman Sachs reportedly plans to streamline its different businesses into 3 divisions as part of a company reorganization. Consumer discretionary stocks, however, led the gains in the broader market amid dip buying in Tesla, following a rout in the electric vehicle makers last week. The rally in the EV maker comes just days ahead of its quarter results due October 19th. Travel and leisure stocks were also in the ascendancy with Expedia, MGM Resorts, Caesars, and Caesars Entertainment sharply higher, with the latter up more than 7%. In tech, meanwhile, Apple rose more than 2% to lead big tech higher after Morgan Stanley rated the tech giant as its top pick, despite suggesting further downside to estimates ahead. Meta Platforms, meanwhile, gained more than 5%, shrugging off a Wall Street Journal report citing internal documents suggesting the company's flagship metaverse product, Horizon Worlds, was running behind schedule. The product has less than 200,000 monthly active users, compared with a revised year-end goal of 280,000, according to the report. Tech was also helped by easing Treasury yields as the 10-year yield hovered at 4%. So, all in all, not a bad day. Again, things do look kind of murky ahead, but we'll take the good days when we get them. So, and just one last article here I wanted to briefly cover. It comes from Yahoo Finance. Bear market in U.S. stocks is still in its infancy versus history. And why I'm not overly ecstatic just because we have a few decent days in a row or over the last few trading days is that we are still pretty young in the tooth when it comes to the current bear market that we're in. We're 195 days right now. The typical average is 318, and you can see here historically, you typically have much longer downturns. So I would, again, if I was just, putting some probabilities on things, I think things probably aren't going to turn around and see the uptrend until sometime next year. Again, assuming that the Federal Reserve doesn't do anything completely crazy and, print up another $4 or $5 trillion, then all bets are off and the market will probably rally to new heights that we've never seen before. So, but this brief article says, history shows that the bear market in U.S. stocks may be far from over. The S&P 500 index has fallen 25% in a little more than 9 months since its January peak, a shallower and shorter drop than its typical or similar instances over the last century. On average in that time, the benchmark has slid 38% over a period of 15 to 16 months before reaching a bottom, according to data compiled by Bloomberg. And with inflation and interest rates rates still rising, recession looming in many economies, and stress on supply chains and corporate margins, there are plenty of negatives for investors right now. Still, Morgan Stanley strategist Michael J. Wilson, a longtime equities bear, said Monday that U.S. stocks are ripe for a short-term rally in the absence of an earnings capitalization or an official recession. So, again, looks like we're probably going to be in this a little bit longer, but that's really not surprising looking back at historical trends and where things will probably bottom out somewhere in that downtrend of around 40%. Could be worse. It was almost 50% in the last downturn back in 2008 and 9. So we shall see what happens. So if you are worried or need some help, feel free to reach out to me. I'd be happy to help you get things together so that you're not getting killed too badly in the markets. And please go to dsafinancialgroup.com to get all my contact information, book a meeting, or just read through all the stuff that I do for folks. So hope everyone has a good evening. I'll be back tomorrow, and y'all have a good night. Bye-bye.